Welcome to Industry Focus, the podcast that dives into a different sector of the stock market each day. It's Monday, June 10th. I'm your host, Jason Moser. On today's show, we're going to dig into the wide world of REITs, real estate investment trusts. We're going to take a look at Docusign's latest quarter. We have a couple of listener emails to get to, and as always, we've got ones to watch for you. Joining me in the studio today, thanks to the magic of technology, as always, it's certified financial planner Matt Frankel. Matt, how's everything?
Oh, just great. You get me all day today. There's not an interview or anything, so it's, just me.
It's just you, baby. It's Industry Focus.
And you're here
the
too. The
Matt days. Well, yeah, but I'm just the host, man. We're going to shine the light on you, Matt. Listen, I had to deal. We had Fool Fest this past week, and that was a lot of talking and spotlighting and stuff. But I didn't see you there, Matt. And you know what? Maddie Argersinger was there, busting into all this great stuff about Million Acres, our new real estate product, and answering a lot of questions. But I didn't see you. Now I know you're working on that product. Why were you not there, Matt?
I've actually never been to a Fool Fest, and I actually didn't know they existed until about 2 years ago.
I feel like that's just borderline criminal, man.
Well, we have our writers' conference every year, so that's kind of what they make a big deal out of for us.
That's right.
I've only kind of been involved in the premium side of the business for the past couple of years. So that's kind of, and they invite me, but they always invite me like 2 weeks before. And with little kids, that really doesn't work.
Requires a little bit more planning. Yeah, I guess.
mean, how much notice do you need to go anywhere?
Oh yeah, me, man. I try to get stuff laid out at the beginning of the year.
Right, and your kids aren't even that little.
No, yeah, they're 13 and almost 13 and 14. So yeah, well, you'll get there eventually. Well, man, I'll remember that next year. I'm gonna make sure to give you a heads up here well before it happens. We'll get you up here for it.
Please do. I'll be there.
Okay, cool. Well, let's jump in today with our first topic. But we wanted to dig into real estate investment trusts, or what some investors may know as REITs. Given that this is the financial show, certainly our listeners always have questions about REITs, and it's a really interesting investment opportunity out there that, I mean, it's not the most exciting topic in the world. I guess maybe tech is a little bit more of a sexy headline than mortgage rates, but REITs can be really rewarding, and they have been here recently, haven't they?
They have. REITs tend to react really well when interest rates are falling. One of the big questions I get, the most exciting kind of REITs are known as mortgage REITs. So that's kind of really what I wanted to go into more today, because those are the ones that have, 10%, 12% or more dividend yields. And that, is enough for a lot of, especially casual investors, to kind of stop and say, wait, why would I invest in, realty income with a 4% yield when I can get 10 to 12% from these? So there are some kind of, really high paying REITs that a lot of income investors really flock to. But yeah, REITs in general tend to respond well to lower interest rates. So that was the best performing sector. It was the only sector that was up in May. And it's just been a really good time with interest rates falling.
Okay, so you're talking about mortgage REITs. You said that's one of the more attractive areas there. But I mean, you have mortgage REITs, you have equity REITs. I mean, tell our listeners a little bit about the similarities and the differences between those two.
Sure. Well, equity REITs are just what you normally think of. Those are the ones that own properties. Mortgage REITs, I don't necessarily think they're the best deal right now, but they're perhaps the most misunderstood kind. They're so different than equity or property owning REITs that they're actually in a different sector of the market. Equity REITs are obviously in the real estate sector, and mortgage REITs are in the financial sector, just because they're completely different investments. Whereas equity REITs own properties, mortgage REITs own mortgages and mortgage-backed securities. But that's not the whole story. They're really very highly leveraged, meaning that, okay, so let me just back up for a sec. Think about it this way. What's your mortgage interest rate ballpark? Do you know off the top of your head, Jason?
Yeah, I believe it's 4%.
Okay, so let's say one of these mortgage REITs buys the rights to your mortgage, which is paying them 4%. They borrow money at short-term rates, say 1% or 2%, to buy that mortgage, because they're not just going to pocket 4% and be done with it. No investor would be really happy with that. So they're going to borrow money at, say, 2% to buy that. And the 2% spread between your 4% and the 2% that they're paying is their profit margin. And to kind of supercharge their returns, they'll do that 5 or 6 times over So they're making that 2% spread, 6 times on every dollar they have. So they're making 10% or 12% of their investment as a spread, which is how they can afford to pay so much.
I think the technical term for that is making money hand over fist.
Right. It's very high leverage. And with leverage comes some risks. I mentioned that REITs generally tend to do well when interest rates are falling.
Right.
But when mortgage REITs really tend to get crushed when interest rates are rising. So we just gave that example of your 4% interest rate and a company, say, borrowing getting a short-term loan at, say, 2% to buy that. Now, if short-term rates spike by, say, just 1%, and now they're paying 3% to buy your mortgage, their profit margin's been effectively cut in half from that 2% gap to a 1% gap.
Uh-huh.
If short-term rates, rise 2 or 3 percentage points, their profit margin can go away entirely or even go negative in some cases. Now, that's a simplified explanation. I mean, these companies have ways of hedging against these, but it's not that long of a show. But so they tend to do really poorly in rising rate environments, and mortgage REITs tend to do also kind of poorly when interest rates are falling quickly. If, say, market rates for mortgages, you're paying 4%, which is pretty low.
Yeah.
But let's say somebody who's paying 7% on their mortgage, and now the average mortgage rate is only 4%. What's that person going to do?
Refinance?
They're going to refinance. Yeah. So you have this prepayment risk when rates are falling, and you'll see. So even if a mortgage REIT ends up buying a ton of mortgages that are paying 5 or 6%, in an environment like we have now, you're going to see a lot of those mortgages be paid off early because people are refinancing, and then they don't get any interest payments.
Aha, I see.
So it's a common misconception that mortgage REITs do well when interest rates are falling, but really mortgage REITs do the best when interest rates are steady.
Okay, well, that makes sense. I mean, I kind of feel like maybe we're generally speaking in a land here where mortgage rates are going to stay fairly steady. I mean, whether they bump them up or down a quarter point, I don't know that really matters all that much. But at the risk of not getting, we don't want to get email from our listeners saying, hey, you led us here to the promised land and you didn't give us any names. Are there any REITs out there, any investment opportunities out there that you like particularly that you think our listeners should take a look at?
Well, I've owned Annaly Capital in the past. That's the biggest mortgage REIT in the market, and in my opinion, the best managed one. Ticker symbol is NLY. It pays right around 10%, I believe. I haven't checked it in the past couple of weeks, but that's by far, in my opinion, the best managed. They also, you can use their scale to their advantage because they're the oldest and the largest in the market. There's a few others that I like. I know my father invests in PennyMac, which on my recommendation.
Hey, I think they have our mortgage, as a matter of fact.
They
make a payment to PennyMac every month.
Yeah, they were formed in the wake of the financial crisis to hold a bunch of distressed mortgages, but have since kind of pivoted because distressed mortgages obviously aren't as big a part of the market anymore.
Yep.
So they've kind of pivoted and now hold people's mortgages like Jason.
Oh yeah, I mean my mortgage is definitely not distressed, Matt. Okay?
Right, that's my point. They've kind of pivoted to be a normal mortgage REIT over the past few years.
Man, oh man. Okay,
it's actually really interesting that you say that because one of their big parts of the business has become mortgage servicing rights.
Oh yeah, yeah.
They don't own a lot of the mortgages themselves, but they own the rights to collect the payments.
It's a lucrative part of the business for sure. I remember working for a time at Bank of America in the lending department there, and I became more and more aware of that servicing side. And it is, man, I tell you, you can make a lot of money doing that.
Yeah, so it's really interesting that PennyMac has the servicing rights to your mortgage because that's once the distressed market kind of dried up a little bit, that's really where they pivoted their business. So it's cool to see that playing out in the real world.
Makes sense. All right. Well, that's great stuff there, Matt. I do appreciate you digging into those REITs, and certainly any of our listeners out there with any further questions on REITs, you can hit us up on Twitter at MF Industry Focus, or hey, even ping Matt there at TMF Math Guy, and we'll see what we can do to answer your questions. Matt, I wanted to take a quick moment here just to review Docusign's earnings. Earnings came out for Docusign late last week. You remember this was the stock. This was my one to watch last week. And it was interesting to see how the market reacted to this release from the after hours behavior to the close the following day, because for a little while, I mean, the stock was getting sold off to the tune of about 22%. And then I think by the end of close the next day, it was down about 12%. And I think everything sort of leveled off now. But I mean, on the surface, it was really a strong quarter. I mean, quarterly revenue was up 37%. Guidance for the full year of 32% growth there on the top line. Also strong. I mean, this is one of those new businesses that's still getting its feet underneath it, so it's not profitable yet. But I mean, it definitely has a model that will be profitable. They have more than 500,000 paying customers now around the world, up from 405,000 in the first quarter of last year. An interesting product they have there, Docusign Gen, which is essentially for small to medium-sized businesses, primarily in the Salesforce ecosystem. And I'm just going to tell you, man, when you're a part of a Salesforce ecosystem, that's a good ecosystem to be a part of. Generally speaking, that is the leader out there in the CRM or customer relationship management space. So that they're trusting Docusign, I think, is a good sign. I think the main concern there with the quarter focused more on the billings number, which at 27% or so wasn't bad. I think it was just maybe a little bit lighter than what expectations were. I think the thing with a business like this, though, is you have to be careful. Billings are very sensitive to timing. And so on a quarter-to-quarter basis, if billings are a little bit weak or a little bit strong, you can't look too terribly much into that. Unless you're seeing a trend develop, which, we haven't seen that yet with Docusign. But a lot of times with a company like Docusign, when they're building out new products and services for their customers and upselling and adding new customers, you can start to see some timing issues play out on how they're renewing contracts and marking for those billings as the year goes on. The bottom line is that Docusign continues to grow its customer base tremendously. I mean, if you look at customers with an average contract value now of greater than $300,000, that grew 51% year over year. They now have 324 customers with average contract value of greater than $300,000. And to put that into context, in fiscal year 2013, that number was just 30. So from 30 to 324. I mean, that seems like a trend we should be getting behind, right, Matt?
Definitely. And I kind of think of Docusign as it's your green dot. I had a very similar situation a couple weeks ago where I gave my one to watch as green dot ahead of earnings. And we did watch it. We watched it go straight down after earnings.
But you explained why. I think you had a good explanation.
Right. And that's my point. On the surface, everything looked good, but there was some like weak guidance, which we saw in Docusign just now. Big thing, investing in new products, which is a big part of Docusign's earnings report. So both of them are kind of investing more for the future. This current growth is a little slower than the market would like to see, and that's why the stock is down. But for long-term investors, this is what you want. Yeah. I mean, this is an ideal situation if you're in it for the long haul.
Yep, I agree. I mean, I think it's, one where the total market opportunity out there for a business like this is just so large. I mean, they're not going to be the only game in town. They don't have to be. I mean, there's there are other companies out there that do it well also. But Docusign is obviously doing a lot of good stuff, and that's what the numbers are telling us. So, I'm hanging on to my shares, and I could certainly see adding to this position over time if it seemed like those numbers continued going where it looks like they're going. I mean, I think, we'll keep an eye on that billings number. And if for some reason we start seeing, a trend developing in billings weakness, then we can address that, because that's something that we don't want to just push to the side. But for now, look like another strong quarter for what is a strong looking business. Okay, Matt, we want to jump into a couple of listener emails here real quick before we wrap things up. Jay Otto sent us an email, and he said, I just wanted to let you know that I bought some shares of Docusign after the dip yesterday. I wasn't waiting for a dip, but it just worked out timing-wise for me perfectly. And then he asks, I hope you don't mind one other quick question. I know Fool Fest was going on, and I was curious, if you're a Fool member subscriber, are you able to attend Fool Fest? It seems like a great event, but I feel like I never hear anything about it in advance. And then I see that it's happening, or maybe it's targeted at a different audience. I'm not sure. Thanks again for all of your great work. Hey, listen, Jay, thanks so much. And I think you probably made a nice move there with Docusign. It sounds like that was just good timing on your part. In regard to Fool Fest, that is, Fool Fest for a long time, it has been targeted to certain member bases. And what we ultimately are doing is growing out the people that we are able to bring into Fool Fest, because we're finding clearly that more people want to come. And this year we were able to move to a bigger facility and really, learn about how to bring in that much of a larger crowd. So I suspect that as time goes on, we will continue to bring in more subscriber bases. So definitely keep an eye out for that. And as always, you can drop us a line at Industry Focus at fool.com, and we will forward any information we have on any future Fool Fests or other events, because they certainly are a lot of fun. And another email here from Adel Naji. Adele asks, what does top and bottom line mean? Top and bottom of what? Keep up the good job. Matt, top and bottom of what?
So that's actually a really good question, just because it's really important to ask if you don't understand the basics when you're starting to invest. So I'm going to answer that one, and I have a couple more of my own. But so top and bottom line refers to the top and bottom of a company's income statement. The top line is the revenue number. That's how much a company is selling. Then you have a bunch of things subtracted from it. Say all your ongoing business expenses, taxes, interest you're paying on debt, things like that. And then you get to the bottom line of the income statement, which is your earnings or your profit. Generally, that's expressed on a per share basis, but you can see a bottom line as a number in the millions, meaning a company's profit. Or you can see an earnings per share, which is also known as the bottom line number. So top line refers to revenue, before anything, just how much a company is selling. Bottom line refers to profitability or earnings. Another term that I get asked about a lot, not on the show, but just in general, so I wanted to address it, is the difference between these three terms: a stock market correction, a bear market, and a recession. These terms are often used interchangeably, and they have three very different meanings. So being that the market seems to move in and out of correction quite a bit over the past year or so, just starting with correction, because that's the most mild of the three terms. A correction just means a drop of 10% from an index or a stock's recent high. So if a stock, or a certain index, recently topped out at 100, a move down to 90 would be considered a correction. A bear market is a little bit more intense than that. A bear market is defined as a 20% drop from recent highs. So if you hear that the S&P just entered a bear market, as it did in the end of last year, that means it fell 20% from its most recent high. Finally, a recession. You'll hear people misuse recession all the time. If, just the stock market's doing badly, they'll say, hey, we're in a recession. And a recession actually has a really more specific economic meaning. It means 2 consecutive quarters of GDP decline. Generally, you hear, GDP grew by 3% last quarter, 2%, whatever. So 2 consecutive quarters of declining GDP is how we're actually in a recession. So correction, bear market, and recession all have 3 very different meanings. The first 2 have to do with the stock market in particular. The third is more of an economic term that generally means the market's going down, but it doesn't have to. And so, those are the 3 terms that are important to know, especially in the context of today's news.
All right. Very good stuff. Well, let's wrap it up for the week here. What is your one to watch? What stock do you have your eye on this week?
See, mine's not actually a stock. I am watching Treasury yields just because of the wide implications on everything we cover here.
Oh, you finance guy.
Well, we have a Fed meeting coming up next week, as you know. I won't be on the show next week, so I kind of wanted to mention this. The interest rates have kind of been jumping all over the place lately, mostly in the downward direction because of the threat of tariffs. But today, I mean, they popped up 6 basis points today as I'm talking, which is a pretty big one-day move. So this is definitely worth watching as we're going into a Fed meeting over the next couple weeks. Banks tend to react positively when interest rates rise. So, for example, if the Fed doesn't cut rates, you might see an interest rate rise after the meeting. If the Fed does cut rates, you might see interest rates fall a little bit, depending on, tariff threats. There's, 100 different variables.
Sure.
So if the Fed cuts rates, it could definitely be a positive for the market, meaning lower interest rates. Could be a negative for banks. Be very positive for REITs if rates kept falling. So a bunch of moving parts there. And the big question on everybody's mind is, will the Fed cut rates? The president seems to think they should. A lot of experts seem to think a rate cut is almost priced in at this point. Goldman Sachs actually came out with a research note a few minutes before I started talking here that they don't think that the Fed will cut rates this year. So that might, be an interesting dynamic. And they said this year, not just this meeting.
I was going to say, that seems to be a bit of a contrarian take altogether.
Yeah, that's a pretty bold call, especially coming from someone as big as Goldman Sachs, who generally is pretty accurate with things like these. So I'm watching interest rates as we go into the Fed meeting. A great one to watch for bank and real estate investors is the 10-year Treasuries. It seems to be a really good indicator on what those stocks are going to do.
Okay. Well, I am going to go with a stock this week, and Salesforce is one that's in the news. If you saw, Salesforce is making an acquisition of a company called Tableau, and ultimately, Salesforce it's an online solution for customer relationship management, and Tableau is a company that's going to help them make more sense of the data that they get and figure out how it can be best used to help their customers. And so ultimately, this just really is a play on the digital economy. And, it's estimated by 2022 that more than 60% of global GDP will be digitized. And I think that makes a lot of sense just if you look around and how we're spending our money today. But I think it's really interesting the way Salesforce is accomplishing this deal. It's going to be an all-stock deal as opposed to using any cash or debt. It stock price near all-time highs. I think that's a clever way to go about it when you got to make a big acquisition like this, $15-16 billion. The stock price is high and you use all stock. That's essentially a cheaper form of currency. And so they will be able to protect the balance sheet. And I think that given the business that they're adding, it should actually be accretive to Salesforce's financials in fairly short order. So shareholders shouldn't really feel too diluted and should still feel happy about owning a leader in the space. With that said, Matt, I think we're going to wrap it up here, man. I appreciate you being here with us this week.
Yeah, it was a fun show.
Absolutely, as always. And as always, people on the program may have interest in the stocks they talk about, and the Motley Fool may have formal recommendations for or against. So don't buy or sell stocks based solely on what you hear. Today's show is produced by Austin Morgan. For Matt Frankel, I'm Jason Moser. Thanks for listening, and we'll see you next week.